Hello, and thank you for joining me on today's video blog. I'm Stephen Pilkington with the Path Home team of Real Broker. And one of the questions that we're getting a lot right now is, how do interest rates affect the sale of my house? How do interest rates affect the market? Because there's been so much discussion about interest rates over the last year, and I'm sure in some cases you're sick of hearing it, but we're getting a lot of questions that people still quite don't know. And so I want to share a couple of things about interest rates and what we're seeing. So number one, when interest rates increase, rates go up, affordability goes down. And so if we look at the overall buyer pool, and if when rates are 5%, if there's 1,000 people in the metro area that can afford your house in your area, and then rates go up 1% to 6%, well, we see about a 10% increase in what that payment's going to be for every 1% change in interest rates. So that means of the people looking at your property, now they can afford less. So less people can afford your property. So interest rates affect things. When interest rates go up, affordability goes down. What also the side effect that we weren't necessarily expecting in the Denver market is that this has caused less sellers to put their home for sale on the market. So inventory has gone down, affordability has gone down, but we haven't necessarily seen prices drop to the level that you would expect. So if payments went up 10%, we did not see a 10% drop in the prices. What we have seen is we've seen a drop in the inventory, and we've seen less transactions happening, but we still have incredibly low inventory right now. So if you're a seller, that doesn't mean that you can't sell for a great price. It just means that there are less buyers looking and they're a little more picky, which is why it's so important now to make sure that you're pricing your home correctly and it's renovated well compared to the competition. Because where we've seen this impact the most properties is with dated properties. So to give you an idea, I run some numbers every single month to share with my clients. And when you're looking at a $3,000 a month mortgage payment, which is now a pretty low mortgage payment, and I'm going to look off to the side so I can reference the number exactly. A year ago in January, $3,000 a month got you $486,000 on average of purchase price, which is about the average price of a starting property for a single family home in Denver. At the worst, when rates were averaging 7.75, that means it went from $486,000 down to $417,000. Your payment didn't change, but the amount that you could afford with that same payment dropped by about 20%, which is pretty incredible. Now we've seen rates come down a bit. So now that same $3,000 a month payment based on current rates, which are averaging about 6.6%, that means we're at $469,000 again. So 486 down to 417, back up to 469. So for those of you that are buying, it got a little less expensive. For those of you that are selling, more people can now afford to own your property. One of the next questions we get is that the news talks about rates going up and down a lot. They are not typically talking about interest rates. They are talking about the Fed funds rate, which is the rate that the Fed is lending out to other banks, to other institutions, to other countries. The Fed funds rate currently is about 5.33%. That helps impact the 10-year Treasury, which is what impacts mortgage rates. What happened last year, even though the Fed fund rate never got into the 6s or 7s, as the Fed fund rate went up, lenders, banks increased their rate because they're expecting it might come up a little bit more. And if they lock you in right here and the Fed fund rate goes up, now they're actually losing money on that loan, even if you haven't even closed on it yet. I know my background was actually mortgage-backed securities and working in the banking industry on the mortgage side. And I know folks last year that there were literally banks that were closing on loans, selling those loans the day they closed on it, and would lose 1% to 3% immediately because rates adjusted. So what does this mean when the Fed is talking about changing rates for 2024? And we know we're going into an election year and nobody wants rates high because it doesn't help anyone right now. Other than pulling inflation back, it doesn't make it more affordable to buy a car, to take out a business loan, to buy a house. And so the Fed has said that they're going to be lowering the Fed funds rate at some point this year, and they're expecting that to be somewhere between 4 to 6 times that they're going to lower it. On the high side, maybe 7 times. And that's about 1/4 of a point each time. So if we're at 5.3 now, they're saying that they may get down to the 4%, but they're probably going to land somewhere in the 4.5. Oh yeah, and they can lower it by 1/8 of a point. So 1/4 of a point or 1/8 of a point. And so what we're expecting for interest rates this year that we've already started seeing is that the mortgage rates have already dropped over 1% from their highs. Now, are we expecting to see another 1% or more drop? That really depends on what the Fed continues to say. If inflation continues to decrease, if jobs are okay, the stronger jobs are, rates will actually stay higher. So if jobs are not as strong, if unemployment is going higher and jobs aren't as great, then we'll actually see better interest rates. So it's almost counterintuitive. We want to see some bad news in the economy in order for rates to get better. The more good news we see, rates will stay higher for longer. So kind of wrapping this up, we are expecting rates to continue to drop. Just so you know, that doesn't mean that the market won't change. As we see rates drop, the buying activity happens quickly and sellers adjust pretty quickly. While we didn't see prices fall very much last year on homes, at least not on homes that were renovated well, and a lot on homes that needed renovation. Those ones didn't do so well last year. When the rate gets better, we see a really quick response. There's a lot of sellers waiting for the rate to get a little bit better so they can go back to the number that they want, and then they're going to list again. So we will see more inventory happening, but it's not necessarily going to be cheap inventory. So if you're a home seller right now, just know that you can sell and get a great price, especially if your property is in good condition. If you're a home buyer right now, know that you have more negotiating room than we've had in years. And when the rates get better, some of that negotiating room will go away. So a lot of different things we talked about here. I hope you got some value out of today's video blog. If you've got questions about this, I'd be happy to connect you with some fantastic lenders who can walk you through this in even more detail, or feel free to reach out to me at any time. I'd be happy to help in any way I can. And until the next video blog, stay warm, stay safe, stay healthy, and I look forward to connecting you on the next video blog.